This is not a, invest because of a spike kind of event. You're not going to have a doubling of primary production if the price is 75 bucks. Just because the commodity price is going up doesn't mean all boats are going to float up. We've seen more of a rotation of capital into the mining names in the last, I'd say, 3 to 4 months. We still have a lot of smaller cap names that investors, larger institutions just cannot buy. There's just less mobile inventory available. Again, stay patient. Don't believe everything on Twitter, please. The things that people write about are so outrageous at times.
Hi, John. First of all, thank you for being here, but I don't want to waste your time with pleasantries. Let's talk about this move in the uranium spot price over the last couple of months. Spot price closed 6% higher last week, nearly at $80 right now. But that's an over 50% jump year to date. Who's causing it if it's not you?
Yeah, thanks for giving me a fat pitch. Well, I think it's pretty clear. Utilities are back in the market and increasing purchases. At the end of the day, the term market is the big market, and it's what we focus very closely on because end use demand is what drives the market forward. Last year, we were excited because we finally got to 125 million pounds of uranium contracted, and that was exciting to us because that was the highest level in 10 years. But what we were waiting to see, and we thought it was going to be this year, was actual return to replacement rate contracting. So think of 150 million pounds as your number that's neutral. So if you're not buying 150 million pounds a year, you're basically destocking your inventory. If you're buying more than 150 million pounds, you are restocking inventory. And so from 2013 to 2022, we've been only destocking inventory. This year, 2023, we believe will be the first year where we actually see utilities restock inventory. Most commentators believe that we're already through 150 million pounds purchased this year through long-term contracts. And we know that since September, when I was in London at WNA, there have been a flurry of RFPs from utilities trying to add to their inventory levels. And remember, not all utilities use a public open RFP process. Many are operating behind the scenes confidentially, having one-on-one dialogues with producers. They don't want to broadcast to the world, hey, I need 5 million pounds. So yes, we see around 10 RFPs floating around the markets from September to present. But you have to think about how many other discussions are going on behind the scenes. Could be an equal amount for sure. So if just to sum it all up, the uranium contracting cycle is finally accelerating, and it's finally getting at or above replacement rate contracting. And I think why we remain optimistic is because a lot of the contracting has actually been happening from utilities in Europe and Asia, and the US utilities, for some unknown reason to us, are still kind of lagging their counterparts around the world in terms of buying more uranium. We saw this last year where US utilities actually bought less uranium in 2022 than they did in 2021 after the price, obviously broke through 50 and held it all year. It's quite strange to us why they haven't been more aggressive in terms of adding to their inventory. And the only theory we have is that we think European utilities, which obviously really felt the brunt of the energy crisis in 2022, just took that as a signal to be much more proactive in terms of restocking their inventory levels. So we think there's more room to come. We think there's more contracting to come. And it's always been said in the industry that, contracting begets contracting. And I think it's fair to say that this acceleration is happening, and that as we move through the cycle, I think some utilities are clearly becoming more and more concerned of whether they're going to have secure supply, because other utilities have jumped ahead of them and procured tens of millions of pounds. So some utilities have clearly dragged their feet, I think are going to pay the price, because we've seen the price in the term market move up. We've seen the caps and the floors that typically get negotiated with these contracts moving up. I'd like to see them move up faster. I was hoping a few weeks ago we were going to get some signals that the caps have gone to kind of a next tier, perhaps $90. But I think it's all kind of playing out right now, and this is what's putting the pressure on the price. Obviously, we've had some supply bumps along the way. Starting with Cameco's announcement that they're having some issues in terms of restarting mines or expanding mines, and also restarting mills. People got to remember these are very complex engineering projects. Some of these mills are very complex as well. And, when you have something that's turned off, whether it's a machine or you don't have the people in place because you let them all go 5 or 6 years ago, and then you try to start these operations up, whether it's digging underground, turning on milling facilities, guess what? Things don't work like they did 5, 6 years ago, because things have to be renewed, new parts. You can't find the parts. It's old equipment. So, the industry is having a few bumps. Niger is still not settled out. No uranium is flowing out of Niger. That obviously is creating concern for Orano, which obviously operates those mines. And, when you see Macron, gallivanting around the globe, visiting Mongolia, Kazakhstan, Uzbekistan, when you have the president of a country running around and signing deals for uranium, it tells you how important the security of supply of uranium has come right to the top of the pyramid. And yes, we've got very good, durable, long-term demand, but the supply is really what I think is driving a lot of the recent price action. Concerns about security of supply against this backdrop of growing nuclear energy expectations globally.
So, and I wanted to ask you, what do you think? Is it more supply or demand driven? But it's basically coming down to it's both. And especially because last time I looked into it, UXC was reporting 140-ish, 145-ish million pounds contracted year to date, and that was at the end of September, which means that there's now been 2 more months. And oftentimes, as you said, they don't catch everything. So they would catch, I've been told by other traders that they catch anything between 50 to 80%. So we're likely above that replacement rate contracting, as far as I understand. Is that what you've understood as well?
Yeah, that's a really great point. And remember, in the uranium market, everything is voluntary, meaning if we buy uranium today, it's up to us whether we want to report that transaction to the pricing reporters. I can tell you we've reported all of our transactions to the pricing reporters because we think that's important in terms of transparency and price discovery. But as you mentioned, a lot of utilities, and obviously countries like China, they don't openly report all of their term contracts. So yes, I have heard similar stats that somewhere between 35 to 40%, or no, maybe let me flip that around. Maybe 20 to 35% of the transactions do not get reported, and it could be more in certain years where places like China are contracting very actively. So we only can go by the reported stats. But I think the point is that the contracting cycle is accelerating. Utilities are finally believing that this price is durable, that it's not just a flash in the pan. And obviously they're making a lot of money selling electricity, and they're getting incredible support from their local governments and whatnot. So I think the psychology's changed a lot in terms of the typical nuclear fuel buyer running these power stations.
And so you say that everything in the uranium market is voluntarily, and I don't mean to argue with you off the bat, but my wife's participation in this market is not voluntarily. Like, she is obligated to be in this market, whether she likes it or not. So I mentioned earlier, though, the buying is, so it's coming from utilities, but it's not coming from you. I mean, it's not coming from SPUT, but you are sitting on a whole lot of cash right now. And today you even announced that you'll be raising an additional $125 million. So talk to me about that. Why is that? Why are you not putting pressure in the spot market right now? And does this raise mean that you will start doing that or doing more of that anytime soon?
Yeah, well, we've obviously been back to a premium to NAV since September, on and off. So we've been raising capital. And let me just first off by saying that we were basically on fumes in terms of our cash position in September. So we need to rebuild that. And remember that as the trust gets bigger, you have to kind of put the cash in dollar terms in perspective. The trust is now at $4.9 billion. And so as a percentage, that cash is not out of the norm. We did just raise a big chunk of cash on Friday, which we have not put to work. So, we've purchased a little under £1 million since September. So we've been in the market steadily adding to our stack, which is around 62 and a bit million pounds right now. But the market is lumpy. It's lumpy in terms of how much material is available to us and at what prices and at what terms. Again, we want to buy in the near-term delivery market, the spot market. We don't view the spot market as up to 1 year delivery. That's silly. We view spot market as you can give me title to those drums sitting in a conversion warehouse in the next 30 days. That's our ideal situation. We have not typically bought out in duration because that represents heightened counterparty risk. And particularly since the war broke out in Ukraine, we've been more sensitive about counterparty risk and more sensitive about any potential disruptions, logistics, shipping of uranium under any kind of longer term purchase arrangement. So we've been sticking to what we think is the lowest risk approach. But as I said, the market is a lot tighter. There are a lot of RFPs in the market, and what we typically see is that when there are RFPs in the market, a lot of participants tend to bid on them, and then until they find out whether they were successful or not, they hold back some of those pounds. So they don't want to sell them if they're trying to openly bid in an RFP process. If they don't become successful in that process, we often see that those pounds then obviously come into the spot market. So I think part of the reason why we haven't seen as much material in the spot market is because people have been earmarking it, hoping that they win some of these longer term contracts. So that's been our recent experience. And then obviously the other thing I would point out that less so recently, but obviously in the summertime, in August in particular, we saw what we believe was steady buying in the spot market by not just utilities, but also some producers that are trying to, build up some of their inventory positions. I think it's fair to say that, utilities, yes, they've got 2 to 3 years of inventory on hand. But I think it's fair to say that some of the producers are also a little bit light material right now because of either, customers flexing up contracts or, short-term production issues. And we've seen them from time to time come in the spot market. And I would say they've been very active alongside utilities up until recently in the spot market.
And you make a good point on thinking about the amounts in percentages, because I've been following the vehicle since you launched it, and it was much smaller. It's now almost $5 billion in NAV. But that also makes me think about this ATM that you announced today, actually, $125 million. That's on the smaller end relative to the size of the fund, is it not?
Yeah, so this is part of the shelf prospectus that we filed in early September. That was 250 million. And what we were asked to do by a regulator is to draw it into 2 different tranches. So we exhausted the first tranche, and now we've asked for permission to execute the second. So it's part of the original 250. And we just did it in 2 different slices. So yeah, this is a smaller amount since historical. It's really hard for us to guess how much capacity we may need at any time. The reality is on the last shelf, we left a large amount that was unused because the way these offerings work is they're time-based. So you have 25 months to issue those units. If you don't issue all of the units within that prescribed time, it basically expires. So on the last shelf, I think we left close to $1 billion unused. So it wouldn't you know, surprise us we shouldn't surprise anybody if some of the shelf prospectuses are smaller than the historical ones going forward.
Going forward as well, because that's what I wanted to ask you. Obviously, forward-looking statements, but how do you think you're gonna? Because it seems like you've just generally matured in your strategy to approach this entire market. I mean, you behave differently a little bit than at the beginning. So going forward, what are you thinking? More like a higher number of smaller raises, or do you think you're going to start coming back in large raises?
Yeah, it's impossible to predict, but I think I would like to focus on the point that the trust has evolved. And the reason for that is because it's matured. You don't run, you know, it's not the same market fundamentals or dynamics when the trust is 600 million versus almost $5 billion. You now have a much bigger float of shares. Some of those shares are starting to recycle back into the marketplace. We see that now. Why? Well, because, you know, people have been in the trust for years now. Some of them have made over 100% return on their money. So I think it's fair to assume that as the fund seasons and scales, you're going to get more natural liquidity kind of and turnover of shares as investors come and go. Now, the good news is that we have new investors coming into the trust that are newer to the story, that are obviously happy to buy those shares from investors that were there a year ago or 2 years ago, or sometimes even longer. So I think it's natural that you're getting a rotation of the shareholder base. You know, we don't have total clarity on what the share registry looks like. I wish we did. But we obviously talk to a lot of institutions around the globe. Sometimes they tell us what they're doing in terms of you know, their positions and their intentions, but a lot of times they don't. They just go into the market, they buy a block of shares, and that's just the nature of the beast with all ETFs. The transparency on them are not great.
You have, as you said, matured in a strategy together with the market. I mean, this has been necessary so far, and I do want to talk about that a little bit in a second. But I'm just reminded of a question here, and shout out to Nick Jones on Twitter for this question. But when you're buying in the market, are you still simply buying U308 yellow cake, or are you buying like uranium UF6 or uranium fuel EUP or something else?
No, only U308. That's been our strategy now for almost 2 years.
Right.
We owned a little bit of UF6 at one point. We inherited it through the acquisition. We found it very difficult to sell, believe it or not, because this was before the war and there was no bottleneck in conversion. Obviously, the price of conversion has gone up enormously, more than 100%. But no, our intention is not to hold UF6. It's a very tight market right now, as you can imagine. Second of all, it's something that's generally less liquid as well, and harder to find right now, if not impossible, because utilities have basically been scrambling since the war broke out to secure UF6.
But so moving forward, you're not going to go actively looking for UF6 or EUP, but if it so happens, you'd probably buy it, right?
No,
Okay.
we just like to focus on U308. It's the biggest market. It's the most liquid market. We've got better transparency on pricing, and we want to just keep the vehicle simple.
Right. Okay. I like that. That's a clear answer. And an interesting point that you make on how different these markets are. I don't think I think enough about how different really the UF6 and the U308 markets are. I might have to get Per on to talk about it. But we're talking about how you've matured and what else you're doing. There's a wild rumor has appeared saying that you might or might not be rethinking your listing on a New York Stock Exchange. Is that a rumor you're willing to entertain or discuss? Is there merit to it? How do you look at it?
We're not exploring it at all whatsoever.
Nothing.
No.
Okay.
No, and the more important response is it doesn't matter.
Okay. How come?
Because if you think about it, the vehicle has been able to scale from 600 million to almost $5 billion without it. So who exactly are we missing in terms of providing access to the vehicle? The answer is nobody. In the US, the the trust trades on the OTC best market. So it trades very healthily on the US market through that OTC ticker. And all the institutions in the world have no problem whatsoever buying the vehicle in the TSX. Now, is there kind of prestige with being on the big board in New York? Sure. Will it improve liquidity? I don't think so. Look, just last week, I mean, the fund traded $80 million in a single day on the Toronto Stock Exchange, not even including the OTC version. So it's not about liquidity. It's not about opening up new institutional investors. It really doesn't accomplish much. And we think the road to an NYSE listing is still going to be very, very difficult because the listing standards there are very different. And we just do not see a path in terms of meeting those standard listing requirements.
Expensive too, probably.
It's not a question of expense. It's the fact that you need to have a fairly open-ended redemption mechanism, and you also need to have a real-time spot market price for uranium. And I would love to have that, but I can't say in good faith we've got one. So that's another standard listing requirement.
Okay, that's an issue. Is that something you think we might have in the future as the whole market matures?
Well, I think it's very possible because the market is obviously through this maturation process is becoming, I think, much more transparent, much more liquid for sure. But are we there yet in terms of like a widely available spot market price? Like, one thing, some of these different brokers and stuff, they show prices. I mean, the bid-ask spreads on those things are at times can be very wide. Like a $2 bid-ask spread is not a liquid spot market, like that is not indicative of a liquid spot market, a real-time price anyway. So until we have that, like we would for like say gold or silver, we're just not there in terms of ticking the box and saying, there's a widely available real-time spot market price for uranium. It's getting better, but we're not there yet.
I think a part of what's also often being discussed when people are talking about your New York Stock Exchange listing is the potential redemption mechanism that you announced a few months ago. And again, emphasis on potential. Nothing has been made public yet. Is that in the works? Or are we going to see anything around that topic anytime soon?
Yeah, so no update on that. We're still actively exploring it and considering it. We've talked to probably 100 institutions directly about it. I'd say the feedback we've received thus far has been very positive. The primary purpose is to act as a discount management tool. And in our experience with our other trusts, it can be very effective in terms of incentivizing different players to come in, buy the vehicle if it's trading at an excessive discount to NAV, tighten up that spread. And if they cannot wait any longer for that spread to tighten, they do have the optionality to tender back the shares and take physical title to uranium. So that's kind of a last resort that we think. Most people will come in, buy the vehicle at a discount and wait for it to tighten, and then sell the shares, or they're just bullish on uranium and they just view it as kind of buying it on sale. Again, the discount management tool is really the primary focus of this, and we don't have regulatory approval to implement it yet. We still have a process to work through, but I think the key takeaway is it would be limited in nature and limited in scale and limited in terms of the participants that would be able to participate. But we do think it could potentially tighten the discount over time. And I mean, theoretically, could a utility be more incentivized to potentially buy the trust if they had the possibility of taking title to material? I mean, sure, absolutely. Will they actually use the vehicle as a tool to hedge and take physical delivery? I have no idea, because as we know, fuel buyers are very different creatures than financial buyers.
Could you maybe elaborate a little bit more on that feature though. I mean, I know you just told me what the main takeaway is, and it's definitely my shallow depth of view here, but I feel like there's a whole lot more to be said, and especially when it comes down to its specific effect on, one, the market as a whole, and two, the SPUT vehicle in and of itself, and how its workings may or may not change.
Yeah, I mean, listen, it's impossible to kind of play out different scenarios of how the vehicle may be used, how it may bring in potentially different groups of investors, including utilities. We have had institutional investors in the past tell us that they were not able to invest in the trust because it did not have a redemption mechanism. So we think that the redemption mechanism potentially helps manage the discount over time. Two, could bring in other institutional investors who thus far have been prevented. And then three, and again, I'm not putting any real weight on this, but it's theoretically possible, utilities could actually use the vehicle as a way to hedge their exposure in terms of, kind of lock in their price of uranium through the vehicle and potentially request redemption from time to time.
Now you're bringing me on ideas. You're putting ideas in my head, because I'm thinking about, could you potentially use this as some sort of an insurance vehicle to generate extra income, where sort of utilities are insuring, where suppliers are potentially insuring utilities by sort of using you as a middle person? I mean, I don't know if I'm making any sense right now.
Well, look, I mean, the reality is there's no real active liquid futures contract for uranium.
Mm-hmm.
So we always thought from way back when that having a liquid transparent vehicle could provide a hedging tool to hedge against your basically the price of uranium. So how do utilities hedge against this today? Well, they buy uranium on long-term contracts, and they typically have a pricing mechanism that determines what the price will be at time of delivery. That's obviously typically designed with caps and floors, so that there isn't a risk that if the price goes to $200 a pound, they're going to have to actually pay that. But if you think about our vehicle, if you were to buy units of it, you're participating with that movement of price in uranium. So the knock has been, well, I can hedge myself from a price perspective, but I can't actually get physical title to it. So if we were to implement a redemption mechanism, that may change that perspective on the value of the vehicle as a potential hedging tool.
That's interesting. Well, definitely be interesting to see how that develops. Is there something else that could change for the way SPUT works? So, because it's a why let me tell you I'm asking this, is because there's a lot of talk about whether that might be the only thing to change in the workings of the fund or not. And more specifically, what I'm interested in is whether there's something you could do about brokers or excuse me, or carry traders allegedly front running you, as in they see you raising money, they know you'll be coming into the market, and they ask, knowing that there will be someone on the bid with a large sum of money ready to mop that increase up. So yeah, does that really happen? First of all, because it's been speculation so far. Does that really happen all that much? And do you have a strategy for potentially dealing with it?
Yeah, I mean, it's impossible for me to answer that. I really don't know. I mean, what people are doing, but irrespective of what games people may be trying to play, I think our approach as being very, very transparent with everything we do has been the right one. Mm-hmm. I can tell you that we did not make everybody happy with our level of transparency. We've had some people say to us, "You shouldn't tell the world what you're doing, how much money you're raising, how much cash you have, when you're buying. Like, you should just go in the shadows, because that's how the industry operates at times." Or I should say some players do. And we argued against that from day one, that being transparent, showing the world every day, what we're doing, what we're buying, how much we're buying, I think has helped legitimize and institutionalize this category and made it I think, more friendly for institutions to get involved. We still find institutional investors that find it difficult to get information about the sector because a lot of it is like from paid services. It's not readily available like you would find with other commodities. So I think our focus on transparency and our focus on education, which is probably 80% of what we do, has really helped, I think, allowed more and more capital to come into the sector, which is obviously our objective is to grow the vehicle, to make it more liquid, because as it gets bigger and more liquid, basically allows more institutions to get involved. And I think as the vehicles become bigger, the sizes of the institutions that we're talking to are getting bigger. So I think that's very healthy. And I think, again, as the fund seasons and matures, some institutions want to basically lock in their profits and move on. Other institutions that are newer to the thesis are clearly coming in and buying their shares. So, you know, I think it's playing out very nicely.
There's something else that's changed, sort of matured as you have, as the market has, and that's been the how should I put it? So since you and I were last talking, since you were last aggressively active in the spot market too, what's really changed is the number of financial players. Some of those have been coming with, you know, changing those desires. As you said, some people have been sort of critical of, hey, why are you so open with the market? Like, you're too transparent with the market. You might get yourself front ran. So let me start a fund that's doing, you know, sort of the opposite of that. How do you look at the number of financial players that we have right now? How do you look at their participation in the market? Does that change anything? Does that influence the working of the SPUT vehicle at all?
That's a great question. Well, first of all, we have no transparency on what any of the other vehicles are doing because they don't provide anything to the market. So I couldn't tell you what they're doing. I couldn't tell you how big they are. They are very, very secretive. So, and that's their choice. That's what they've decided to do. And I'm not going to comment on that. We've obviously taken a different position, but it's fair to say that other parties have looked at I think the change in sentiment around nuclear power and uranium and the success of the SPUT vehicle and are saying, hey, you know, how do we capitalize on this? And everybody's trying to come up with different ways to bring offerings to market. That's great. That's healthy. That's a sign that the market is recovering, that the market is recapitalizing. But I can't tell you what they're doing because they're not telling the world what they're doing. So it's really hard for us to know. Now, look, we're the leader in the world. We want to remain the leader. We're not going to just sit on our laurels. We're constantly thinking about ways we can make our vehicle better. I think the redemption idea that we are working on is a good example of us being proactive. We were clearly not happy with the way the trust was trading in the summer. And yes, we were in kind of a air pocket where sentiment was soft. Liquidity in the market across many asset classes was really soft as well. But we just viewed it as an opportunity to think differently about what can we do to make the vehicle more attractive to a greater set of investors. And you know, if you want to be a leader, you need to keep evolving as well.
That's a lesson. I felt like that was a personal lesson right there, not even anything to do with uranium. But it's you're right. We don't know what the funds are doing. What I was mostly wondering about is sort of like, is the spot market behaving differently right now? Like, as in, you know, looking at the carry traders, for example, and their activity or lack thereof over the last few months, looking at what BHP is doing or not doing. I mean, for as far as I know, is the market different now than the last time we spoke? It must have been 6 or 7 months ago.
Yeah, for sure. The market is different. And the reason for that is that utilities have purchased a lot of material in the spot market in the last few months, or I should say this year. I would say producers have bought a bunch of pounds in the spot market this year. And I think it's also fair to say that there's also the dual tension of utilities with needs for longer term deliveries that are potentially competing for material that would otherwise go into the spot market. So I think all of these factors have had an impact. You also don't have as much mobile inventory available as you did a year ago. Why? Well, because, Japan is obviously restarting more reactors. So we think some of that material that naturally would have been fed into the spot market is no longer available. Generally, when you just, take a step back and look at all the pounds that have been purchased by ourselves, Yellow Cake, hedge funds, another, a whole bunch of uranium, mining companies that are sitting on material. There's just less mobile inventory available from the period where we obviously had a supply overhang. A lot of that supply overhang is, in our opinion, cleared, and now the market's getting into more balance. So less inventory, more buying by utilities, more buying by producers. And I do think that we are finally moving to a period of overfeeding. There was a lot of talk about it last year, but it wasn't really happening until more recently. And it wasn't really happening because we just didn't have the capacity to start that process. But with the restart of ConverDyn, I think that was a key bottleneck that's been removed. That facility has been very, very busy. And we've seen also a steady, very steady interest in people looking for material specifically at that location, because that facility's resumed after being turned off for years. So we also see a lot of buying pressure or tension from parties looking specifically for material at that location. So again, that's part of this kind of reshoring of the supply chain back to Western facilities.
Right. But so well, more or less in conclusion, the market has gotten a lot tighter. And I think that's also just to be seen on the move in the spot price over that term. And but also something else that I'm thinking about, just the general working of the market. And shout out to Casper for this question on Twitter. He asked it, and I'd be completely lost for words if it weren't for the good folks on Twitter. But is there a given point in time, any given day or part of the month in which you see an increased supply in the spot market, or sort of a short-term bump in the supply in the spot market?
Not really. There are contracts, offtake contracts that deliver material to the different purchasers at various times in the month, which tend to be in the back half of the month. But that doesn't necessarily mean those pounds are always available for sale. They may have already been sold forward. So in our experience, every day is a little different. As I said earlier, RFP activity in the market definitely tends to have an influence on availability of material as well. So if there are a lot of RFPs in the market, sometimes we find players are very quiet in terms of their willingness to sell until they find out whether they were part of a successful bid or not.
Okay, so what happens then to those trades?
Well, there just are no trades. Like sometimes there's days where there might be, 100,000 or 200,000 pounds trade all day. Some days there's no trades. Some days there could be 500,000 pounds trades through multiple transactions. It's very unpredictable, and I like to use the word lumpy in terms of the activity flow.
Okay, and that hasn't necessarily changed too much over time. I mean, that's kind of how uranium has always been, or is it not?
It's always been like that for sure. We saw a lot of activity. It's very unpredictable. Like in August, we saw a ton of activity. The prior August, we saw no activity. So it's very unpredictable. There's not as much. Now there is some seasonality to it. January tends to be a busy time. From WNA onward, it tends to be a busy time. Why? Because utilities are in this contracting cycle. So, in the term market, yes, there is some seasonality to it. But the spot market is definitely less predictable.
Right, but that's exactly what I was sort of wondering about, whether there's sort of seasonality within a month like you have it in a year, but you said there's not. Do you have any insights on what BHP is doing? That's also, talked about a lot. Do you see any of their pounds ending up on the market?
We have not purchased anything from them in a while, so that's all I can say.
Okay.
We have not seen a lot of material coming out from them recently, so I can't comment on what they're doing with the Olympic Dam material, but we have purchased some in the past.
Okay, sure. Okay, let's not go deeper in that. I understand what you're saying. So in a while, that's a good point. Why I'm asking all of this is because there seems to be sort of two camps forming when it comes down to uranium investors. One that says a sort of a gradual increase in the price is going to happen. It's going to occur over a couple of years. We're going to stay sort of at a healthy level. And then another one that says that you could, go on vacation for 2 weeks and come back to see the uranium price at $500. What camp are you sort of in, and has that changed recently based on the behavior of the spot market?
Yeah, so I would say we're more in camp one because that's the way the market is designed to operate, meaning you've got utilities that have 2 to 3 years of supply, and so they don't have to knee-jerk react to anything. But on the flip side, you have a sector where a very large percentage of production comes from a very small number of people or companies and countries. And so it is much more vulnerable to supply shocks, and is obviously more geopolitically charged than other commodities. So I don't think you need to, you shouldn't be investing with this kind of spike kind of mentality, because nobody can predict those kinds of events. What we can predict is that between now and 2040, there's 1.5 billion pounds of uncovered requirements based on the projected capacity additions for nuclear energy. To us, that's the slow and steady approach in terms of the contracting cycle. Will basically grow over time to cover off those required pounds. Obviously, we need to produce a lot more uranium for that to happen. The spike kind of scenario is really going to be driven by some kind of a black swan event. It's going to be sanctions. It's going to be a mine issue. It's going to be, a war. I mean, again, you don't really want to invest with those kinds of events in mind. So our approach is it's going to take a staircase type path, and that's what we've seen. It's gone from kind of 30, 35, 40, 50, more recently 60. Now it's trying to find footing and seasoning at kind of 70. Where it ultimately goes, I don't know, but we obviously think the price is still going higher because of the 1.5 billion pounds of uncovered requirements is going to require a doubling of primary production. You're not going to have a doubling of primary production if the price is $75. It's just not happening.
Right.
So where that price settles out is hard to know, but we definitely think that in the next couple of years, the price is going to be triple digit. I just don't know how much more, how much more it's going to go, but there's a very good thesis still underpinning this trade. So
Sure.
we remain very constructive. We still have lots of institutions getting involved here at 75. I'm sure they wish they got in at 50, but they still see a very constructive future for the sector.
Well, I'm happy with that answer. It's a good answer. There was someone on Twitter who said, just ask him how high the uranium price is going to be next year and what stocks to buy, and end the interview there. So I could have done exactly that. But so what if I watched an interview of one of you, of your physical trader, so Peter Jander, that we mentioned earlier as well. He said in an interview that there might not even be a ceiling for the price of uranium because of how the market is set up. And he actually said that he's having a hard time imagining the uranium price coming below $70 as it is right now. Is that sort of your opinion as well?
Yeah, so I think what he was referring to is whether the long-term contracts that utilities are engaging with producers will have caps on them. And that's impossible to predict. I mean, obviously, a utility is not going to want to have an unlimited liability. It would be very hard for them to accept that. But I think the more important point is that the caps are going up, reflecting the scarcity of material, as well as the durable demand that we see going out to 2040. So I think that's what we're focused on, is seeing those caps continuing to move up, so that the producers can capture their fair share of the economics. And you got to remember, a lot of these producers for years were really at the mercy of utilities who were destocking. So the contract terms that the utilities got for a number of years were very in their favor. That is obviously, for the last, I'm going to say, year and a half, shifted. We're no longer in this period of utilities being able to openly brag about coming into the spot market, buying whatever material, whatever amount of material they wanted, whatever price, fixed prices, flex terms. I mean, those days are gone. Now the reality is, you need to pay your partner a fair price, otherwise there won't be long-term security of supply. And that these projects, just like building a power station, are incredibly capital intensive. And if the money is not raised to build these projects, we will not have supply in 2030, 2032, and so on. And that's the real risk. So as we know, the price of uranium is a very small part of the overall operating costs for a nuclear power station. Nuclear power stations have the luxury of buying a lot of uranium forward, holding inventory, holding additional reloads of fuel on site. So again, this is not like running a natural gas power plant where your gas pipeline was cut and you don't have any supply, or you don't have, you've got to pay the market price, which might spike. This is a very different commodity that people need to understand operates differently. So I keep reinforcing that, because this is not a, invest because of a spike kind of event. So we would counsel people to have a longer term view. It's going to be, volatile along the way, which we've seen, but we think generally the trend is up. And I think that's why it's a compelling, why we think it's a compelling opportunity.
There's also one other person on Twitter by the name of Mr. Bojangles. He wanted me to ask you what happens when an RFP doesn't get fulfilled. And this fits right within what you're telling me right now, that producers are starting to have the upper hand. But first of all, can that realistically happen? Like, could there be, you said there's 10 RFPs in the market right now. Could it so happen that they just don't, like, nobody answers on them? And what would that mean for the market if it happened?
Yeah, it's a great question. I don't know the answer, to be honest with you. I mean, I think generally contracts are getting filled. Otherwise, we wouldn't have a 150 million pound contract book already locked in for this year. But perhaps what would happen is, delivery windows might have to stretch out in the future, or prices have to go up to reflect the costs to expand production. I think the market is pretty efficient in terms of adjusting these kinds of parameters. At the end of the day, higher prices cure a lot of issues, because we know there's uranium in the ground. The question is, how much is it going to take to pull out of the ground? If the price of uranium went to $200, well, I can tell you, certain places in the world, they would go through a bonanza in terms of people trying to extract uranium out of very low grade deposits. So, you always have to keep in mind that in commodities, there's always a supply response. As price goes up, you have a supply response. That's happening right now. The challenge we have is that all the easy stuff will come back online by the end of next year. And then after that, you're getting into the more challenging greenfield development, which doesn't take 1 or 2 years to bring back online. It can be 5, 6, 7, 8 years. And that's really the challenge, I would say, in the next 5 years, is whether we can actually build some new mines and bring new production, like meaningful new production. I don't mean, 1 million, 2 million pounds per year, but I mean really bigger, chunkier mines. Can we build them and bring that production online in the next 5-6 years? That's going to be the big challenge.
Well, but talk to me about that as well, because we're seeing, I mean, right now, very topical, a soon-to-be producer is trying to finance itself, and the market is not having fun with them. Or well, the market is having fun with them, but the shareholders are not having fun looking at the stock price, basically. And I suppose that might also be more of a topic when we look at these deposits that start needing, 500,000 together, maybe with a couple of other deposits of north of $1 billion. Is there enough money to finance those on time and build them to respond to the demand, basically, is what I'm asking. But you have a better insight on that because you see the financings much closer than I do. So talk to me about that.
Well, I think it's fair to say with all resource type projects, if the projects are of very high quality and in the right jurisdictions, capital will, and you've got a very supportive commodity price, most important thing. Capital will find its way to the project and it will eventually get built. So you see some of these uranium developers, they obviously have very attractive projects. Now they need to be financed, they need to be built. But we think that in this cycle, there's a very good probability that happens. For less desirable projects in less desirable parts of the world, yeah, absolutely. Those projects are going to struggle in terms of attracting investor interest, attracting, sufficient returns on capital to get built. So, just because the commodity price is going up doesn't mean all boats are going to float up. There are going to be winners and there are going to be losers. And you see that with all commodity cycles. And just because it has the name uranium in the company, it doesn't mean it's necessarily going to win in this cycle. So, I think investors need to do their homework very carefully about the individual companies. I think that's also why a lot of investors are opting just to buy baskets of ETFs. And we're starting, and one thing I think we should talk about is that we are finally starting to see the uranium equities come back to life. And I mean from two perspectives. One, they're performing better. And we know that from November of 2021 until, let's say, July of this year, they were lagging the commodity gains, which was obviously very frustrating to people. But in the last few months, we've seen a rotation emerge. That rotation is starting to come in two ways. One, they're starting to perform better relative to the spot market. So that's important. You're actually getting this kind of optionality and operating leverage start to work in your favor. Second of all, we're starting to see capital come back. And we obviously track all the dollars flowing into all the uranium mining ETFs globally. And since August, we're starting to see consistently capital come back into those products, which is another good sign, which means despite all of the, I would say, general anxiety about interest rates, inflation, are we going to have a recession? Investors are actually starting to display more of a risk-on attitude right now when it comes to uranium mining equities. So we've seen a noticeable shift in August in terms of they're performing better, capital starting to come back in. I think with our own ETFs, we're outselling SPUT the last few months, which is amazing. So I think that's a very healthy sign that we're starting to see the equities perform better. We're starting to see capital coming back in. And that's obviously important because, as you mentioned, a lot of these companies need capital to get their projects either going or restarted. And the other thing I would mention about some of the smaller companies is they're actually having dialogues with utilities. And so it's not just the Cameco's and the Kazatomproms that are winning all the business. These smaller producers or future producers are actually being invited to participate in these RFPs or long-term, purchase discussions with utilities. That's another really healthy sign because Some of these are going to have to sell forward some of their future production in order to help facilitate whatever debt and equity capital that they need to raise in addition. So that's another healthy sign that it's not just the big guys that are getting the contracts, that some of these contracts are starting to permeate down the food chain.
That's a very interesting point, because I did want to talk about that. I wanted to talk about specifically about sentiment. I know it, sometimes a little bit superficial, but I know that you spend your time going through requests, talking to people, including like for sometimes, real journalists, like even on CNBC. So how are you experiencing the change in sentiment when you're talking to people, basically? Again, I don't even know how to ask it because it's superficial, but talk to me about it.
Well, look, sentiment is very important. You can analyze all the fundamentals, but even with very positive fundamentals, we can hit periods in the market like we did in May, June, July that were brutal. I mean, we follow sentiment very closely through a number of different ways. I could tell you, people were kind of washed out and were throwing in the towel. And what happened in August? The market took off. So sentiment in the short term can have a big impact. I do think that you have to take a step back and say, what were people talking about 2 years ago or 3 years ago with respect to nuclear energy? Well, not a lot, or if they were talking about it, wasn't overly favorable. Now you're talking about whether it's a Wall Street Journal, the New York Times, or the Washington Post, or Barron's, or CNBC, Reuters, Bloomberg. I mean, these mainstream news outlets are covering nuclear energy and uranium very regularly. But it's not just about the regularity, it's about the tone. The tone has changed. It's much more positive. Nuclear has gone from, 2 years ago or 3 years ago, I'd be answering like very basic questions like, is it safe? What about the waste? Now it's about, oh, well, this can help decarbonize and this can provide energy security. It's unbelievable how the narrative has changed as people's understanding has improved. People understand how energy systems work. People have understand some of the risks and vulnerabilities we have because of things like Nord Stream and sanctions and whatnot. So I think the topics that we talk to people about have changed enormously. The media has gone from either non-existent or negative to very active and supportive. I think from a psychological perspective, I think that does help more institutions in particularly get involved in the sector if they think that it is okay to, because let's face it, for a long time, and even today when I talk to some institutions in Europe, they tell me it's on our exclusion list. We can't invest in it. No matter how positive the fundamentals are, how much profit there is to be made from this, we have a complete exclusion on investing in the sector. Okay, fine, move on. We're not going to convert everybody here. But the sentiment overall and people's perceptions of nuclear energy have really, really changed. And I remind people that it really happened at COP26 2 years ago in Scotland, where it's like finally nuclear energy was given a little bit of the stage and people were talking about it as a potential solution. We're coming up to COP28 in Dubai in a couple of weeks. I know there's a very big net zero nuclear summit happening in parallel there. It's going to be very interesting to see what the tone and what kind of coverage we get out of COP28. But it may sound superficial, but it's not. It does help people become more comfortable investing in a sector that was very, very kind of off limits for a long time.
When you're talking to these people, what is the thing they take most interest in among your offerings? Like, is it SPUT, URNM, or URNJ?
Well, I would say institutional investors are attracted mostly to SPUT. Why? Because it's the largest, most liquid vehicle. And many investors still have challenges, institutional investors, that is, going down market cap with some of the smaller names in the sector. But I can tell you in the last 3 or 4 months, we've seen a rotation where we're starting to see more, let's call it advice and institutional channels starting to buy the uranium mining ETFs. We've definitely seen a rotation of investors back into some of the equity names. And I think that's another healthy sign, and it's a sign that investors are willing to take on more risk investing in the sector. So institutional investors, yes, very heavily own SPUT, but we've seen more of a rotation of capital into the mining names in the last, I'd say, 3 to 4 months.
That's exactly what I was going to ask. Is are you seeing more questions about it? Because actually, when there's risk on days on the market, URNM still, I mean, the both ETFs perform almost the same at times, and the URNM sometimes even outperforms the URNJ. But oftentimes when I talk to, like, for example, Rick Rule or whoever else, it might be like an expert on specifically picking stocks and investments, they would say, the juniors' time will come. It's just not now. And then later on, as the cycle matures, they will start rotating. And so that's what I was wondering, whether that rotation has started happening yet. So talk to me about the URNJ specifically.
Yeah, so just on your comment about rotation, we definitely think it's happening. Now, again, you have to kind of peel away the layers here, because the reality is, up until a few months ago, the only equity that was really working, other than the spot price of uranium, was Cameco. I mean, it was basically going straight up. It was up, I don't know, 80% until everything else started to catch up. And most of the capital was going there. In the last few months, we've definitely seen a rotation of money where we've seen some profit taking. We've heard about some people taking some profits in Cameco and rotating down market cap into kind of the next layer of companies. But I think the main point is that we're starting to see greater participation in the rally. Again, not all companies are going to go up with any kind of rally, but we're seeing better representation, more companies going up than down, as some of that money is starting to find its way down market cap. But as I've said repeatedly, the biggest challenge to getting capital in the market are not the fundamentals and not sentiment, perception, it's investability. We still have a lot of smaller cap names that investors, larger institutions, just cannot buy. There's just not enough liquidity for them, or they've got too many, risk management restrictions and parameters that wouldn't allow them to buy. So we've generally seen smaller institutions be more aggressive and be more proactive in terms of getting positioned in the equities. And the larger institutions have focused more on the physical, I would say, the physical commodity vehicles in the marketplace.
And is your job as when I say your, I mean Sprott's job as a manager of these ETFs, is it becoming harder when the companies are becoming more active, and we're seeing some of those companies, transition from an early stage explorer to a discovery play? Some of those companies are moving through feasibility studies and so on and so forth. So you have to, balancing the ETF last year and rebalancing the ETF this year sounds to me like it should be more difficult. Is it, or is it just the same?
Yeah, so the ETFs that we manage obviously track third-party indexes that we license. So we don't control who comes in and comes out. Everything is driven off a set of rules or a methodology, an index methodology. And when those indexes come up for rebalancing or reconstitution, they basically have to follow a very prescribed process. So every rebalancing period, what happens is, if a company's market cap falls below a certain limit, or its liquidity softens, well, that could be a potential exclusion, meaning it gets removed out of the index. If a company grows its market cap and improves on its liquidity, that could make it eligible for inclusion in the index. So it's a dynamic process. Companies are coming and going, obviously, based on their development and their growth. So it's never static. And again, we don't make any discretionary decisions on that. It's completely prescribed through a set of well-documented and transparent rules.
Okay. Well, that's URNM, URNJ, SPUT. We talked about all these. Is it something else Well, you probably can't tell me about it, but you can maybe give me a hint. Another something vehicle in the making, something that you would like or want to make at one point in the future.
Well, we've been, obviously pretty busy with launching new ETFs this year in the US and Europe. So we're happy with what we have on our shelf. We're always looking for new ideas. We've obviously been really happy with the growth of URNJ. It's it fills I think it fills a need in the market that wasn't met before by allowing people to focus on all of the smaller cap names. And it's great to see the fund start to scale. Our fund in Europe is starting to scale as well. So we're really happy with our partnership with Han ETF. And that's basically a clone of URNM and a UCITS wrapper. But uranium, I think we're pretty well covered in terms of of adding more to our suite. So I think we're just, right now we're focused on just scaling all those vehicles.
That's a good point. Yeah, it's a good point. What else are you excited about outside of uranium? You launched the COPJ ETF, if I'm not mistaken. A bunch of other products actually. What else are you excited about?
Well, we're constructive on the longer term copper story. We think that the world is going down this path of increased electrification in many different applications, whether that's electric vehicles, renewables, energy efficiency, heat pumps, etc. And just simply, the fact that large parts of the world are still energy impoverished. They consume very little amounts of energy relative to what you and I enjoy. So the world, we think, is going to add massive amounts of electrification. And copper is kind of your backbone metal in that whole infrastructure, whether it's transmission, cabling, wiring, electric vehicles. Copper is a mineral that we've obviously been mining for thousands of years. All the easy stuff's been found and mined. And if you look at different projections from different parties, we need anywhere from 50 to 80% more copper going out in the future. And the copper market is already a $200 billion a year market. So you're talking about growing a very sizable market at a time when ore grades are falling. The easy stuff's been found. We got to go deeper and deeper. Some places are having water issues. So we're very constructive on the long-term price of copper. And that obviously underpins our decision to launch, a copper mining ETF in the United States. So that's something that I would say is going to be an increased focus for us in 2024.
Do you also have any insights on, and I understand I'm asking almost impossible questions here, but do you have any insights on maybe what some of your competitors and larger competitors like your BlackRocks are doing, and whether they would eventually want to enter the market as it gets more popular, not copper specifically, but just uranium, just the metals market in general?
Yeah, I think it's fair to say that some of the very large sponsors, the BlackRocks of the world and whatnot, are right now building out suites of ETFs that are focused specifically on a number of energy transition materials. They see the trends that we've been watching the last few years, and they're never going to be early, but they definitely seem to come later. And they have been launching funds on both sides of the Atlantic. We see them launching funds in the US as well as around Europe. So I think that's a good sign because they see the longer term opportunity. They see in growing investor interest. It's great when we get inbounds from different plans or pension plans that say, hey, we're interested in this energy transition thematic. Talk to us about uranium or talk to us about copper. Honestly, 2-3 years ago, we would never get into these calls. They just weren't interested whatsoever in any of these metals or minerals or mining. They were just focused in different areas of the market, but perceptions are changing, capital's moving. People are looking for new ideas, new themes, new trends. And we think a number of these metals are going to be big beneficiaries. They're going to be bumpy along the way, but, longer term, we think copper is going to do fine. Lithium is going to do well. Uranium obviously is kind of further ahead in terms of its bull market. But we think a lot of these materials are going to see heightened demand, and in many cases, we need to increase production by very meaningful amounts to balance the markets. And that's obviously what creates opportunities for the commodity prices as well as the many of these producers. We've also seen a lot of M&A activity across not just the copper universe, but also the lithium universe. And that basically signals that people are viewing lithium and copper as very strategic assets. Everybody wants the best projects. And oftentimes it's easier to buy than to build. And so we've seen a lot of M&A activity in both copper and lithium in the last 12 months.
Just when you said it's easier to buy than to build, I had a thought, like, I probably shouldn't be surprised if in like 5 to 10 years I wake up and I see a headline: BlackRock acquires Sprott Inc. for $20 billion or something along those lines. If they're really looking to get serious. I'm not going to let you comment on that because you probably also can't. But I'm not hearing anything about platinum, though, which is also sort of a sentiment check, because it might also be too early, because there's just not many platinum equities to make an ETF out of. That's something you've thought or looked into?
Well, we actually have a physical platinum and palladium fund in the United States. Platinum is definitely coming out of a very long-term funk, where it really underperformed for a long time, but it's definitely showing some signs of life. And we've had some capital come into the fund recently, so I think that's a good sign. Palladium obviously had a kind of meteoric rise when the war broke out in 2022. Given how much palladium is produced by Russia, the price has since collapsed, which is a little mind-boggling. So yeah, the markets are kind of shifting back, where palladium outperformed for so many years platinum, and now platinum is kind of leading the pack. So yeah, definitely some signs there, but I'd also say there's still some uncertainty in terms of platinum's role within hydrogen production, how the adoption of EVs could potentially impact platinum usage. Obviously, a lot of platinum today gets used for catalytic converters for diesel combustion engine cars, which since the Dieselgate scandal a few years ago have really suffered enormously in terms of market share of new car sales. So it's hard to really know, what platinum's role is going to be in this kind of energy transition scenario, but it's definitely performing a little better. And your point about, you just can't find pure play companies that produce platinum or palladium out there. It's pretty hard to build a vehicle around that. So, which is why we've got the physical vehicle.
Yeah, good point. That's sort of what I thought. I think I've been through most of my talking points. I also don't want to take up your entire morning there. What else? What did you come here hoping to talk about, but I'm failing to bring up uranium or otherwise related?
I think we covered. I think we covered really good ground. I mean, our key messages are that the market seems to us to be shifting into the next phase of this bull market. We think it started to shift last spring, and it's been accelerating since August. The contracting cycle is really what's driving the market higher, and this is something that I think everyone has been waiting over a decade to see. These cycles do not last a year. These contracting cycles, based on the past, can last several years. Again, think of it as a destocking cycle, and now we have a restocking cycle. So this restocking cycle is underway. At the same time, we have a pretty serious supply deficit around 2030, unless we start to build new mines. And that's going to be the big challenge that I think the industry has in front of it. But, capital is finally coming back into the sector, which will give companies the opportunity to build these mines and or turn on existing ones that have been on care and maintenance and finally get back into revenue and cash flow again. So these are all very healthy developments. Again, stay patient. Watch don't believe everything on Twitter, please. It's still pretty wild. The things that people write about are so outrageous at times. We try our best to be transparent around what's real and what's fiction. But, again, you got to invest with the right time horizon, with the right expectations. And it's obviously worked out really well. Our investors done very well with SPUT, and we hope they continue to enjoy gains into the future.
You're making a service to the public by telling people that they should sort of come down and stay away from FOMO, and don't let yourself get hyped up on Twitter. And for any all official information on Sprott and its vehicles, just go to sprott.com. That's SPROTT.com. John, thank you so much for investing your time with me today.
Yeah, thanks for having me. It was great to catch up and talk about our favorite topic.